Welcome to Sierra Capital's Family Office Fundamentals, a podcast dedicated to helping families preserve their legacies and wealth for future generations. I'm your host, Zev Zaretsky, Investment Director at Sierra Capital, a 25-year-old multifamily office focused on guiding ultra-high net worth families globally. In each episode, we'll explore a wide range of topics, including investments, trust and estates, family governance, philanthropy, and much more. Our goal is to provide you with a solid foundation to safeguard your family's financial, intellectual, and human capital for generations to come. Join us on this journey and stay tuned as we hear insightful conversations with industry experts and thought leaders right here on Family Office Fundamentals. Let's embark on this journey together. Please find important disclosures at the end of this podcast. So welcome to Family Office Fundamentals. I'm here with David Demeter. And so technically, David, it's your first time as an actual guest on my podcast, but some people are probably thinking, wait, I'm pretty sure I've heard David on the podcast before. So sort of, where we were both on the panel at the SBIC conference, and I was given that recording to essentially do a podcast and just review and do key points. So David, you have the unique distinction of being featured on my show twice now, but actually being interviewed today. So today we're making it an actual official podcast.
I'm looking forward to it.
Yeah. So just a little background. So David is the investment director at Davidson College's Endowment. You lead investments across hedge funds, venture capital, private equity. Previously, you managed investments at University of Michigan's Endowment. Clearly, that gave you a valuable perspective across different institutional scales and mandates. And beyond your endowment work, David, and tell me if I'm wrong here, you're the chair of the Limited Partner Council at the Small Business Investor Alliance, right?
You're wrong.
I'm wrong.
I used to be. Yeah. That title now has been bequeathed to Chris Sears at Truist Bank.
All right. So, David, welcome to the podcast for real this time.
Yeah, thanks for having me.
And it'd be great if you could want to give our listeners some background on your path from Michigan to Davidson and kind of what drew you to take on your past leadership on the SBIA councils and just kind of what you're doing now.
Thanks, Ev. Yeah, I've been with Davidson College's investment office for the last 8 years. It's a $1.5 billion endowment, a little north of Charlotte, North Carolina. I'm a generalist here, as you mentioned. I help look over all investments with Davidson's chief investment officer, Ray Jacobson. And before that, I was at the University of Michigan investment office for 12 years, where the last about half of that period, I was more focused on marketable assets and private credit. Yeah, I got to know the SBIC market a little over a decade ago from that private credit investing at Michigan. While I was there, we cut much larger checks because it's a much larger endowment, and we pursued a strategy of building a portfolio of more credit-oriented SBICs. We built that portfolio initially with 7 investments. That was just to get more scale, to make it more meaningful to that larger endowment portfolio. In credit, returns are asymmetrically negative. You have a lot of small wins and a couple of big losses can wipe those out. Given that we were going to do more funds to try to build a portfolio, we were a bit worried about that. And we developed a strategy where we decided to back strategies that started at the top of the balance sheet, where a large loss would be a lot less likely if your manager wasn't in control of at least the balance sheet of a company.
So this is back at Michigan. You started doing the senior lending stuff and then started moving downwards?
Yeah, so anything from senior lending all the way down to a one-stop buyout. A lot of those strategies had meaningful equity exposure, but they typically also controlled all of the debt of a company.
Well, so at Michigan, like you were saying, you're operating with a much larger asset base. How did that scale kind of influence the mandate in general? Like, were you gravitating towards more traditional strategy, larger check sizes, like the big names that everyone knows, the more established manager relationships, or like?
Yeah, we were, I wouldn't say more established. If we wanted to write a bigger check, they had to be a newer manager to find that capacity in a fund. And then we were looking specifically for groups that are doing non-sponsored investing, where they were the financial sponsor themselves. So they had significant influence over the underlying portfolio companies, both to help improve those companies and grow them and make money that way, but also to control them in a downside scenario and prevent losses. Because again, we were worried about that asymmetry in credit investing.
So I guess that's your time at Michigan. Now you're
Yep.
at Davidson, and we've spoken before. You could do more of a barbell strategy, high conviction managers. If you could explain what that actually looks like in practice.
Yeah. So at Davidson, relative to our peers, we do a lot more investing in hedge funds that don't take a lot of market risk. That diversification and liquidity from hedge funds allows us to take a lot more equity risk on the private side of our portfolio. Today, about 30% of the endowment at Davidson is invested in venture capital, and another 15% is invested in other liquid private assets that would be predominantly various forms of private equity, including SBICs. Yeah, in Michigan, my part of my responsibility was to help make private credit investments. So we were often making the investments I described in SBICs on the belief that we could have private credit-like risk, but private equity-like returns. Here at Davidson, as I'm a generalist and just searching for more total returns on the private side, given our barbell approach, I gravitate more towards the equity buyout strategies within the SBIC world. So I'm looking for that private equity-like risk, but greater returns.
Is the thesis that a smaller endowment could be more opportunistic? Is that is that true? And do you think that's because of like there's capacity constraint managers and market inefficiencies with the smaller funds that a larger institution just can't spend their time looking at the smaller managers?
I'd say generally speaking, a smaller asset pool is easier to invest and can be mainly because it can be more concentrated in the best ideas and it can access that allocation in capacity constrained funds and smaller funds. Smaller funds, like especially within private equity, the best performers tend to outperform like small funds tend to outperform larger funds where you find more small funds in top quartile rankings because they have greater positive skew. Like they have winners that just tremendously outperform. That's pretty much what separates the top quartile from lower quartiles, as opposed to losing less money. Um, that's still important to preserve capital, but it's those winners that really separate the top quartile funds in private equity land.
Yeah,
And trying to get into those small funds, certainly with a smaller asset base, is easier.
right. Is there a deliberate strategy to kind of hunt where big money can't go? Like, are you looking for strategies where like a 10 to $20 million commitment actually moves the needle for the manager, but wouldn't be material for like a Yale or a Michigan or Harvard?
Yeah, I mean, I think it's an advantage to have to only put out a 10 to $20 million check. I do think the returns, like I said, can be found in those smaller funds. And in those smaller funds, that 10 to $20 million is going to be more meaningful to the manager. You're going to have that trusted relationship with the manager that's hopefully transparent, where you can follow what they're doing over time and make sure it's consistent.
I definitely see with the smaller managers, it's definitely a lot more relationship driven than just looking at the numbers, looking at at the investments made, and
Yeah, I mean, it's a bit of a cliche to say, but every year, as I've gotten doing this longer, it's more and more easily a people business and an alignment business. Um, can you trust people to look after this money correctly like you would like?
right.
And most managers often say the same thing in the lower market about their underlying corporate management teams. It's a people business.
Yep, I agree. So let's kind of segment, and we'll put your XLP council hat on.
Sure.
Digging into the SBIC program. So for listeners unfamiliar, which there shouldn't be many since I've done plenty of podcasts on SBICs, um, quick pitch. Why would an endowment allocate to SBIC funds?
I mean, I think for the same reason anyone with long-term capital would. Um, it's about excess returns, and SBICs outperform on average.
And I guess what? So that's a function of, you know, potential 2 to 1 leverage, um, that's government backed. Probably the mandate focusing on small businesses. From my perspective, there's a structural market inefficiency there.
Yeah,
Um,
it's a more inefficient market, especially at the lower end of the lower middle market where SBICs fish. The intermediaries there's a much greater spectrum of intermediaries for finding investments. Um, and it goes back to the, thing I said about small funds. A very small business has much more potential upside than a very big business. And that really determines, who the top performing funds will be, those positive outlier returns.
Yeah. Well, so you like to do the buyouts
Yep.
at Davidson and using the SBIC structure. So traditional SBIC structure, the standard debenture program, right, requires semi-annual cash interest payments, and that creates some challenges for a buyout type of fund. For equity and buyout, you got this fundamental mismatch. You're investing in equity that generates returns through value creation over 4 to 7 years, but you need to be able to service the debt semi-annually in cash. So I've seen people do it a little differently. From your perspective, what's the best way for managers to deal with it? You got the one-stop shop structures. You have guys that do a little bit of debt on the same portfolio companies just to purely create cash flow to service the debentures. From an LP perspective, what have you seen to be kind of like the best strategy for buyouts using debentures?
In the debenture program, buyouts are typically there's a little bit of senior debt, and the buyout manager owns their own mezzanine. I typically don't want to see more than 2.5 or 3 times senior debt on a company. These are typically very small companies, $3 to $5 million of EBITDA, maybe a little bit larger. You know, they're more concentrated in their business lines. It wouldn't be uncommon for a company in an entire portfolio to have a 50% drawdown in their EBITDA. If you're starting out at 2.5, 3 times, I mean, you could quickly become 5 or 6 times and start having a discussion with that bank. And I would rather avoid that situation because it's just not necessary to hit interesting returns in an SBIC. Owning their own mezz is very interesting just from how you think about it mentally as a model. If there's a lot of situations where effectively the same amount of capital you're borrowing at the fund level from the SBIC program is roughly the same amount of money you're putting into the mezz of your own companies. And at that point, you're just it becomes an arbitrage. Because instead of paying some mid-teens yield to some third-party mezzanine lender, you're lending that effectively to yourself, taking that interest and that interest rate deduction on the taxes of the company. And now you're borrowing at, call it 7%, the headline interest rate of the SBIC leverage plus the management fee on top of it. And you're just making an arbitrage. You're reducing both the risk of that investment and increasing the return, which
Yeah.
is very fun in my business.
Yeah. Well, it's a little bit of both, right? You got the credit exposure and the underwriting, but I guess you have a much more friendly sponsor since it's yourself.
Well, yeah, and you're far less likely to have any individual portfolio company fail, get in trouble with a lender. And the lower cost of debt just accretes to your returns.
Yeah. So how do you think the like IRR versus MOIC, and even like DPI, like the cash drag from servicing debt early on? Obviously, it compresses IRR early on in a fund, um, even though the ultimate multiple on invested capital could be much stronger. How is it that you got Davidson College kind of comfortable with that?
Yeah, there's a couple of points I'd make. Yes, you're paying management fees on the leverage, as well as your commitment to these funds. Um, you can bucket that a couple ways. The uh, the pessimist would say you're paying, 2 or 3 times normal management fees. And that's not wrong. But if you are, then you're paying like super low SBIC leverage interest rates, right? You're paying just that headline rate. I tend to think of the management fee as an added cost of capital to the leverage. Either way you bucket it is right. I just see it as a cost of capital you have to beat. And once you start thinking about that, it becomes a little easier to understand the math of how an SBIC works. Yes, you are levered into the J curve. The J curve And the investment period for an SBIC is 5 years, as opposed to a typical like 3 or 4 in a non-SBIC. So you're both levered into the J curve and it's going to be longer. Uh, you just have to have really long-term patient capital to do that. And you also have to have managers who have a really good sourcing. That is an added risk. You have to be able to deploy even in environments where M&A is slowing down, and you have to still deploy into good companies. Um, so it is a minor risk that you have to be acknowledging when you're doing this. That there is some deployment risk in those first few years. If managers get behind the deployment schedule, you're going to feel it in the J curve the first few years. But on
Yeah.
the flip side, I would say SBICs are known for recycling capital a lot more than non-SBICs, which I love. If they're a good manager, they will recycle some of that debt capital that comes back to them. And that helps build multiple and lower the average expense ratio over the whole life of the fund.
Yeah. It's an
I
added
wish,
benefit. Added
yeah, I mean,
benefit.
it's one area where you consistently see people recycle, to get above 100% of your commitment invested. Whereas it's difficult in non-SBICs to even get people to recycle into their management fees.
Yeah. Yeah. And I think that the debenture question, like obviously for buyouts, a little different than just the pure credit funds, where it's essentially very similar to just like a NAV line, net asset value line facility that the SBA is giving you at just a much better rate.
At a much better term because there's no refinancing risk.
Right. Yeah. So, but then we have the accrual debenture program. I haven't personally deployed any capital, or none of our clients have deployed capital into the accrual program yet. But that fundamentally changes the cash flow dynamics. And maybe you could walk us through how this works. Like generally, interest accrues rather than being paid. So like the debenture program being paid semi-annually, interest instead is being accrued, full amount of principal plus accrued interest is paid not at maturity, right? It's being paid first before LPs get distributions.
Correct. Yeah. I think you made a good description of it. And the difference is, the strategies can then invest 100% in equity. We've we've backed one fund and we've looked at several others that are doing buyout strategies within the accrual program. It's very much becomes that. What's your cost of capital and can you have investment returns that beat it? I still see managers under levering companies at the portfolio level. And you're typically seeing companies that have a little bit higher growth, characteristics. So yeah, the downside of the accrual program is you can't get as much nominal leverage, and you can't get as high a ratio of leverage. But you can invest 100% in equities, and so I think a lot of those things sort of equalize. The one drawback that I would note is that sort of waterfall as money is paid out of the fund, it is paid pro rata. Well, it's paid first to pay down the interest and then paid out pro rata to pay down the principal of the debentures and the accrual debentures and also to LPs. As
Got
opposed
it.
to in the debenture program, if you had a certain, they call it a read test, but it's effectively a retained earnings test, a conservative one that you could beat. Once you had that, you could pay out 100% to LPs when you sold a company. The difference in those waterfalls is probably a few percent in net IRR, but it's still a very interesting market, especially because you can probably hit higher gross IRR, gross unlevered IRRs being 100% in equity.
And you're saying it's a couple percent hit on IRR purely because of the longer duration? Like,
No, because of the waterfall.
it's
I'm saying all things equal, that waterfall probably cuts a few percent off your net IRR versus a debenture SBIC. But things aren't equal. You can invest 100% in equity.
yeah. Yeah, there's gives and takes in it with everything. So the first accrual program investment you made is buyout, not venture, correct?
Correct. Yeah, I'm a little skeptical of venture within the accrual structure. Venture is a very long duration investment strategy, especially early stage venture. I think late stage venture investing could make sense in an accrual SBIC. Why I like SBICs generally is that the term of the debt, you draw this debt down in tranches, and each tranche has a 10-year term. And you just can't see anything like that commercially. It's a very long time. That's why I said before, there's effectively no refinancing risk. And reinvestment risk is one of the scarier risks in finance, right? That's like the cause of every financial blow up outside of frauds. Every bank run is refinancing risk. Um, so I really want to avoid refinancing risk. No one really knows what happens at the end of the 10 years if an accrual SBIC doesn't have liquidity and the SBA wants their money. I assume they would just foreclose on that SBIC. So if you haven't generated liquidity by the end of that 10 years, a venture fund using an SBIC is going to have to be going into the secondary market and maybe force selling a position. And last most saleable thing will probably be the most interesting in their portfolio, which is probably the last thing they should sell. While I think that 10-year duration could work for late stage venture, I wouldn't want to try it with early stage. Maybe multi-stage could work. I don't know. I think what's one interesting thing I heard a GP bring up was the idea of using the leverage to fund reserves, i.e., money put aside to go into later rounds of the companies they've already backed. That would delay that investment a few years, push that debt term out a few years. I think that might make sense. But yeah, it's something that they're going to have to keep a very close eye on because it's a meaningful risk.
Moving away, we kind of spoke about the SBIC, the structure and everything. How about in terms of your like quantitative analysis? And this kind of connects directly with the work you did with the SBIA when you were doing the LP Council stuff and some of the stuff you're doing now with UNC. You can't make informed allocations decisions without rigorous standardized performance data. We go back a few years, there was definitely a measurement challenge in trying to benchmark SBIC performance through different vintages and different managers. I know you did a lot of work with UNC's Institute of Private Capital. I have podcasts with them on that. But when you're evaluating an SBIC fund, you're looking at levered returns. There's another question that's, for sophisticated LPs, how much of that return is structural leverage, the structural, like the returns are coming from the leverage versus the actual manager's skill. So maybe you could talk a little bit about the work you did with performance testing and trying to get it more standardized throughout SBIC investors, and then a little bit of work on that.
Sure. Yeah. When I was LP Council chair, one of the biggest needs and demands of LPs, and including myself, was for better data. And the SBIA, working with the Institute for Private Capital, which is headquartered at UNC Chapel Hill's Business School, with Professor Greg Brown. They worked with the SBIA, worked with IPC to put together a survey, and I helped make some suggestions over, what would LPs want to see. And I'm proud to say that they are restarting that process this spring to do the next version of that paper. But yeah, the original paper, IPC was able to benchmark SBIC performance against non-SBIC performance using the Burgess database owned by MSCI.
Yeah.
And Burgess's universes are probably the best, most broad universes for small funds. So it was really cool to be able to use that universe to benchmark. And what they found is across all SBIC strategies, SBICs tended to outperform by about 4% on a net IRR basis versus non-SBICs, rough with a, rough like-to-like strategy. I think, it just makes sense as gross returns get higher, that outperformance increases because it's leverage. And if you dig through that report, you can see that some of the levered equity strategies tended to outperform even more. And yeah, this year, the survey has been adapted a little bit to try to drive more detail on how much and what factors are causing the outperformance, how outperformance works vis-a-vis the weighted average debenture interest rate cost, as well as how much leverage is being used at the fund level. There are critics of the program that think the quality of managers in the program is lower on average than the broader, lower middle market strategies that are non-SBICs. I tend to disagree. I think there a lot of lower quality managers do get screened out by the SBA simply because they don't have a good track record or they don't have a long enough track record. On the flip side, I bet, yeah, maybe some of the most desirable GPs to invest with don't even bother with the program because they have a lot of investor demand. I think some of the tails is what I'm saying get cut off. That paper found something like 75% of the debt funds outperformed their non-SBIC equivalent. I mean, when you have that much of a skew in the hit rate, I'm pretty sure it's just leverage.
Are there specific metrics you're talking to UNC that you guys are going to try and pull from managers that you didn't last time?
Yeah, so we're going to ask for that weighted average interest rate cost. Going to have and we're also going to ask for gross returns, gross IRR, gross MOIC. So we can kind of see how the leverage ratio and the interest rate cost translate into net returns. I think there's going to be a little more emphasis on duration of capital. So we do know, just anecdotally, that SBICs tend to recycle more. So when we compare multiples to non-SBICs, if we have a better sense of that duration of capital, we'll have a better sense of like why is the multiple larger? Is it just because they recycled, or is it the leverage? Or obviously, it's some combination. They also have access to some underlying cash flows of funds from the Burgess database. They might be able to do more detailed work. We'll see to show like a comparison of J curves or a comparison of DPI.
Yeah.
I think could be interesting.
Of course, all this data is amazing. Getting enough funds that it's actually material, especially if you want to do vintage year breakdown, right? Because typically the
Yeah.
leverage costs are going to be the same for the funds doing the same vintages, assuming the sourcing is the same,
Well,
or
the,
the
the goal
pacing is
is
similar.
a very important goal of SBIA in order to get GPs to participate has been to keep all of the data on an anonymized, aggregated basis. So no one at SBIA sees the data. It gets delivered directly to UNC, and the people working on the project are covered by an NDA with SBIA. So it can't be shared outside of a couple of people. And the problem they encountered last time with showing vintage year data was there often just wasn't enough funds in some vintages, older vintages, to have vintage year data. The only way you could have really
Yeah.
done it is if you mixed all of the strategies into vintages. And then it's like, well, what does that really mean to have like a 2015 vintage with like 5 buyout funds and 30 direct lending funds and 2 senior debt funds?
Yeah. No, you definitely need more. Hopefully more people report, and if people have retired and
Yeah.
closed their funds, maybe they'll still respond to the emails.
Yeah, I tried last time. I tried emailing all of the defunct out of all the defunct groups that had SBIC licenses, and we got a very low hit rate on those. But I am optimistic people that are currently in SBIA members and currently in the SBIC program uh, will respond as well as they did last time. It was a large portion of licensees that responded.
Yeah. And it's also going to be good just to roll it forward. Does increased market activity and deal activity, does that actually create value for SBIC funds? Do they perform better in that market, or do they perform better in when there's valuation headwinds?
Well, I mean, I think the valuations in the lower middle market are more steady than other parts of private equity. And so it matters a little less. Uh, Ultimately, this part of the lower middle market, their goal is basically to build a platform and sell it on to a larger private equity fund. And so, yeah, the health of the upper market is very important for this part of the market, especially from having, if the upper market has unfunded commitments, having that dry powder. They have deployment schedules too, and they will pay up. And I think high quality assets have sold at very high valuations as a result, even in this market. Ultimately, I care about the structural health of the upper market. to make sure I'm still comfortable investing in the lower market. And when you see things like, high net worth investors being able to potentially invest more into private equity in the mega buyouts funds and stuff, I think that is going to be long-term health for the lower middle market to be able to sell platforms up to those echelons.
Yeah. I actually like this market environment more so than when there's a ton of deal activity. Because personally, I think that when you start seeing great, grade C, B companies trading more frequently, um, credit standards get a little bit looser, money becomes a little bit easier, and underwriting might not be as robust as what it is right now. So
Sure, I can see that.
I guess from if you were going to a nice cocktail hour with a bunch of institutional allocators, other endowments who are, let's call them SBIC curious, but haven't committed capital yet, what would you say they should be evaluating first?
I'd say ask SBIC GPs for their fund models and just make sure you understand the math because it's a lot of people just think, oh, this is just financial engineering or, oh, I want to anyone can financially engineer something. I think the SBIC program is more special than that. If you're talking about like mega buyouts and I'm going to put 8 turns of debt on a company instead of 5, yeah, I'd agree. That's just financial engineering that anyone can do. SBIC leverage is very special. It removes refinancing risk in a big way, and it's very low cost and it's super accretive as a result. And that pickup you get in net levered returns is substantial as a result, and you can't just brush it away. And so I would encourage people to look at fund models from GPs and just make sure you understand what that pickup in return is.
Yeah. And I guess from your personal experience at Davidson and kind of if you were to write down what are your key requirements for future SBIC investments that you'll make, what are the top 3 or 4 things that you look at in a manager that you won't even there's no point of even having a call if these things aren't checked.
Losses. It's really important to work out your losses and to try to maximize recovery. I think if you have too many big losses, you need to have a really good explanation. Um, I think too much consumer risk is another thing we would try to avoid. Well, some is fine, but we're not looking to do pure consumer. Um, you can have some big losses there. You know, Operational value add. A lot of people can just go buy a business and lever it. Great people make better businesses. They can recruit interesting management teams to these small businesses, which is sometimes a challenge. Um, you know, Having a bigger team that can consistently source is very important. As we described, deployment risk is an issue in SBICs, slightly more than a non-SBIC. So having consistent deployment, and we don't tend to back people who are very narrow in focus in terms of sector, and we don't tend to back people who are generalists. I think there should be a few sectors of what people are good at, have the networks to be able to source, have the networks to be able to add a lot of value operationally. Um, and I think people have to be very clear about what their goals are around leverage ratio and fund size. These are going to be slightly moving variables because of potential new legislation.
Right.
And this whole potential new concept of bonus leverage. Are you going to over equitize in anticipation of that? Just be very clear with what your intent is. Because yeah, I don't think the leverage ratio is everything. Ultimately the most important variable is gross returns. And yeah, maybe you should raise a little bit more capital to pay for, more team members, more resources to go accomplish this and execute.
Yeah. You named two of the biggest places where I spend my time during my underwriting is going through workouts. I haven't really determined what's like. You could look at overall historical loss ratio, But you really got to look at it fund by fund and see what's been trending.
Yeah, I mean, this isn't a lot of the things I'm looking at aren't credit investments. So I'm looking where a manager has significant influence or outright control of a company.
Yeah.
They're incented to go improve it to improve their equity value. Um, and
And
then
then,
it's, yeah, sometimes it's parsing what was the cause of those losses. Obviously it isn't always one thing, but did they pick poorly? Did they, were they buying momentum when that momentum wasn't sustainable? Was it management team execution? What did they do about it? How did the GP respond?
yeah. So there's the workout, and then to your point, I think sourcing is one of the most important. If you're able to source a ton of good deals and you only have to pick 3 or 4 a year, I'd rather be with that guy than the one who has a little bit of an issue sourcing good deals, or sources a lot of deals, but they're just a bunch of broker deals that are not that great. So,
Absolutely.
um, but no, this has been great, David. I really appreciate you taking the time. Not sure if there's anything you wanted to leave with anyone, but having you on incredibly valuable for myself, for anyone who's going to be listening. Glad we finally got you on the podcast as an actual guest rather than just reviewing your comments on different panels. I definitely appreciate the work you've done on the performance transparency. I think that's been super important. So I'm glad that you got that done before.
Oh yeah, and all credit goes to the IPC and Greg Brown doing all that work. I just gave some perspectives of what LPs might like to see.
Yeah. Well, look, it's definitely helpful, and I'll put the link to the to that old report and to the SBA report as well into this podcast. Not sure if there's anything you wanted to add.
No, Zev, thanks for having me on.
All right. So, David, thanks, and thanks for joining us for Family Office Fundamentals. And until next time, well, I'm sure I'll see you soon.
Thanks, appreciate it.
The information presented in this podcast is the opinion of Sierra Capital and does not reflect the view of any other person or entity. The information provided is believed to be from reliable sources, but no liability is accepted for any inaccuracies. This is for information purposes only and should not be construed as an investment recommendation.